Hi everyone, welcome back to Guide to PNC Systems where we simplify insurance concepts. Today we are going to discuss about perils, hedges and risks and how they impact premiums. So what are perils in insurance? Perils are the specific causes of loss that your insurance policy includes or excludes. There are two main types. Named perils, specific risk explicitly listed in policy like fire, theft or health. Open perils, also known as all risk coverage, protects against all cause of loss except the ones those specifically excluded, like flood damage is often excluded in standard homeowners policy. Why do perils matter? Perils matter because they define what kind of risk is covered by your policy and it directly influence your premium, and also it help you decide which policy form to take. Policies that cover greater number of perils generally come with a higher premiums. For example, a named perils homeowner policy is cheaper than an open perils or all risk policy that covers almost everything except exclusions. Now, what is a hazard in insurance? A hazard is any condition that increases the likelihood or severity of a loss. Types of hazards include physical hazard, a tangible condition that increases the likelihood of loss, faulty wiring that increases the chance of fire, moral hazard, when someone changes their behavior due to having insurance. For example, exaggerating a theft claim. Moral hazard, carelessness because you feel covered. Legal hazard, it comes from laws or regulations that increases the likelihood of cost of insurance claim. And yes, hazards affects premiums too. An old roof may increase your fire or water damage premium. A history of inflated claims may lead to higher cost or even declined coverage. And finally, what is risk in insurance? It simply means a possibility of loss from a peril. A policy is intended to protect against. They are of two types: pure risk. It is a type of risk with only the possibility of loss and no potential for gain. For example, your house may burn down from fire. You either suffer a loss or nothing happens. Typically, the kind of risk insurance covers. Speculative risk, it involves either chance of loss or gain, like investing in the stock market, and insurer don't cover this kind of risk. The greater the risk, the higher is the premium because insurers expect to pay more claims. For example, a home in Florida faces higher risk of hurricane damage, so premiums are higher than for a similar home in Ohio. So to recap, risk is the uncertainty of loss, perils is the actual cause of loss, and hazards is the condition that make those losses more likely or severe. If this helped you understand the basics, don't forget to like, share and subscribe. Thanks for watching.